The RBA cut was anything but a surprise in the end, but the post-cut dynamics in the market have genuinely surprised financial markets, especially once again the resilience of the Aussie dollar after the rate cut. Now that we have a 1.5% official cash rate, only 1% above the United States, most forecasters were expecting the Aussie to head back towards 70 cents or lower. However, despite the cut and expectations of further interest rate reductions as the chart shows, the Australian dollar has moved back above US 76 cents, and the 90-day bill rate is only down 5 basis points or so, from 1.85 to 1.8%, not the typical reaction to an interest rate cut. Perhaps evidence of the diminishing impact of rate reductions the closer we get to zero. Later in the week, we saw some fairly mediocre data reads. The international trade deficit widened to $3.2 billion in June on falling export values, and this chart shows building approvals fell 2.9%, admittedly from a reasonable height and mainly due to public approvals falling by 34%, with private approvals only down marginally, but enough of a fall to suggest that the next GDP growth read may be significantly lower than the 3% previous growth rate. And just to cap off a pretty forgettable week, you can see here that the retail sales numbers missed their mark, showing values rising only 0.1% in June. But the latest rate cut may see that bounce back as we move into spring. So not a lot of good news around, although to leave you with a positive thought, business expectations moved sharply higher in the latest Dun & Bradstreet survey, taken after Brexit and the federal election. And while a rate cut won't solve all the world's problems, for businesses it may be the fillip needed to drive confidence and those much needed animal spirits that textbooks tell us drive the economy. More on that next week when we analyse the Reserve Bank's latest official statement on monetary policy. Until then, that's the market update from Bendigo Bank.